Income Tax 2020. Tax software example, itemized deductions, interest you paid. Come in, relax with Income Tax 2020. Here we are in the Lacerte tax software. You don't need the Lacerte tax software to follow along, although I do think they have a 30-day free trial, so if you can get access to a demo version to practice with, it might be a good tool to use. We're going to be focusing in on the 1040 and then the related Schedule A, focusing in specifically on the interest paid portion of the Schedule A, going back and forth from the data input to the forms to run different scenarios. The tax software helping us to do that quickly. We have our beginning point, our typical beginning point with the single filer for Eric Smith, living in Beverly Hills 90210, 100,000 W-2 income, 12,400 for the standard deduction, giving us the 87,600 taxable income. We can also see that on our Excel worksheet. We have the 100,000 income, 12,004 standard deduction, and then the taxable income at the 87,600. We're going to be looking to the itemized deductions now and seeing if the itemized deductions will be taken. They will be if they clear the standard deduction threshold, which will depend on the filing status for a single filer, that being the 12,400, married filer, that being the 24,800. So let's go back on over to the software then. We're going to then go over to our Schedule A, and our focus then is going to be in the interest you paid section. When considering this section, we're narrowing down typically on home mortgage interest. So remember that if you're working with somebody in the past, or a client that you had in the past, or your own taxes, then if you itemize in the prior year, if the taxpayer itemized in the prior year, then they're probably going to itemize, meaning use Schedule A in the current year as well. That would be your default position. If they had not itemized in the prior year, then the thing that pushes most people over oftentimes is the purchase of a home. So if they purchase a home, then you want to look into it in more detail. The thing that will trigger it in your mind is either they will tell you they purchased a home, and that should do it, but also you might get a 1098. A 1098 would look something like this, and that's going to be from the bank reporting the interest, not a 1099, because a 1099 makes you think of income, something that might have to be reported in income. 1098 is something that's going to be reported, but possibly an expense in this case, or possibly something that could be deducted like an expense. So that's what we're going to be thinking of here, the home mortgage interest. Now, if someone purchases the home, then they also might have property taxes, which could also be substantial and could also be something that would be pushing us over the mark for itemizing. That would be in the taxes paid section. So let's jump on over and enter something here. We're going to imagine then we have the home mortgage interest. We're imagining we have then a 1098 that would look something like this, and we would be populating it with the 1098. Now also note that if it's the first year that you're setting up the interest, then you might want to look at the first year of the purchase, or a refinance of a loan. Then you might want to look at the closing documentation to see if there's any points involved that you would have to include that aren't in the Form 1098. But in general, you would think that the interest would be on the Form 1098. So let's say that we had 12,000 on the 1098. And again, if you had the home mortgage interest, you would expect then to have taxes. So you would expect, if you have home mortgage interest here, to have some type of item in the property taxes. So let's make that 3.5. That would be a state tax, often deductible then for the federal tax purposes, also an itemized deduction. Then if we go back on over to the forms, we got the 12,000 here. We got the state taxes there. That's going to add up to the 16,560, which of course brings us over the threshold. So if I go back to the 1040, that brings us over the threshold. So now we're taking the itemized deductions as opposed to the standard deduction, given the fact that we're over that 12,400 on the itemized deductions. Now note that these standard deductions are higher than they were a few years ago. So even at this level, if they were married, then we would not have it, because we'd be at 24,800. So let's check out that. If I go back to the deduction or the detail, and let's say Eric got married, we're going to say Eric's getting married again. Eric's getting married. And we're going to say married Jane, Eric and Jane. So then we're going to go back on over. And so now we have married filing joint. And now we have the 24,800 here, which is the standard deduction. We're not taking then the itemized deductions. They're no longer here because we're not over that threshold, even though we have a substantial amount of interest and the property taxes. So just realize that when you're talking to people that are looking into purchasing a home, oftentimes the idea that you could deduct all the interest is going to be an incentivizing factor, but it could well be the case that you're not getting a benefit from all the interest that you'd be deducting. You're only getting a benefit from the part of the interest that clears the standard deduction threshold. So going back on over, if we go back to single here, so we'll go back to single, say, nah, I don't want to get married. Go back to single, and then we're going to go back to the forms. So that's where we stood last time. And so single filing, and then again, now we're taking the itemized deductions at the 16,560. And that's the main part of it. You should get documentation to it, and then you got to think about if there's unusual kind of circumstances, and we can look at basically the instructions to take a look at that with regards to the home loan interest. So on line 8, we have the home mortgage interest and points. So remember that the idea of points could be a little bit confusing, and that typically is something you're going to take into consideration when the home was purchased or when the loan was taken out or when the refinance happened. Once you have taken care of it there, then if you're using the same software, it should be something that should populate or be pretty straightforward from that point forward. So if you don't use all your home mortgage loans to buy, build, or improve your home, see instructions and check this box. So in other words, the general rule is that you took out the loan to buy, build, or improve the home. If that's not the case, then you're going to have to go into more detail and possibly use some kind of ratio in terms of the amount of the interest on the loan that you might be able to do. And notice that this, of course, is the interest you're paying, like the rent on the loan. And you're comparing that to the loan proceeds that were received, the loan proceeds that you would have gotten in order to purchase the home or to do something else with it using the home possibly as collateral. So home mortgage interest and points report to you on Form 1098. So these are going to be the ones reported on the Form 1098. That's what you're going to get from the financial institution reporting the mortgage interest. Home mortgage interest not reported to you on Form 1098. So you could have a situation where you didn't get a 1098 for whatever reason. Again, that would be a more unusual situation. See instructions if limited. If paid to persons from whom you bought the home, see instructions and show that person's name, identifying number, and address. Again, the most usual situation would be that you would have a financial institution with the loan that would then have to report the points using a 1098. So points not reported to you on Form 1098. So if you had some kind of points that weren't reported on the 1098, that would typically be something that would have to be taken place when you look at the actual closing documentation for the purchase or the loan or the refinance. Mortgage insurance premiums, and then you add lines, and then we have the investment interest. So I won't go into the investment interest in detail, but let's just take a look at the Form 4952. So what I'm going to do is I'm going to jump here. I'm going to right click and jump. I'm going to go into the investment interest, and I'm just going to populate and say we had investment interest of 1,000. And then let's take a look at the form. If I go back to the forms, should be populated now. So I'm looking at 4952, Form 4952. Now remember, this is an interest that we're saying we needed to expend the interest. We had to take out a loan in order to help us generate revenue, which would be kind of like a business expense, which would be similar to what you would think would be like kind of a deductible activity, as opposed to taking out a loan for personal use, like for a personal, boat or something like that. So the investment interest expense paid, so we had the 2020 that we put in place. So here we have the total investment interest, and then we have the net investment income. So this is the kind of income that you might, have to take a loan out against possibly in order to generate that income, and therefore it may be possible to deduct on Schedule A. So we got gross income for property held for investment. So the income for property that's being held for investment. Qualified dividends included on line 4A. So I'm not going to populate this because it's a little bit more unusual, but just be aware of that. Also note that you can have instructions over here. So if you have questions about this line and like Lacert, you could hit F1 and it'll go to some of the research information so that you can go to some more detail on it, which can be a useful tool to at least start your research if you have questions about a particular item in the data input. Similar functionality could be with other softwares as well. So now I'm going to go back on over. I'm going to go to my forms and I'm going to say, okay, so now note that we could enter this. How would we enter this into our Excel worksheet here? Same kind of process. We would then say, okay, now I'm going to see if we itemize. So I'm going to go to the itemized deductions and I would take this information from the source document once again. So I'd go down to the interest and I would be taking this from the 1098, which I think we said was 12,000, and the taxes I think we said was 3.5 or something like that for the real estate taxes. And then I would pick up the taxes here from the software. I'd have the software kind of help me out to calculate the state taxes typically, although you could kind of figure that out from the W-2 and other withholding information as well, since it's on kind of a cash basis. But I've got the 1,060 there, so 1060, 1060, and that's going to add up to the 16,560. So we've got then the 16,560, and that should then flow through to the first page. For the first page, I'm then going to say this is going to be equal to the itemized deduction. So now I have both of them there, and I'm going to take the greater of the two, which is done by the formula, and that's going to give us down to our taxable income of the 83,440. So if I go back on over, this is going to feed to the first page of the 1040. First page of the 1040, and there's the 83,440. Is that what we had over here? Yeah, 83,440. So you can see how that kind of flows forward, and we could basically double check the taxable income line and then go from there, and we'll take a look at the second half of the formula in future presentations. But this worksheet can help you to give you that basic double check by having two people do most of the data input separately, or having one person enter it in two separate locations from the source document as much as possible. The source document in this case being the 1098 primarily